Russell Jones, Global Head of Fixed Income Strategy at Westpac Banking, joins us from Sydney. And hopefully you've had a restful weekend, wiped the brow, and starting off this new trading week. But what's the mood like starting off here on Monday?
I think it's still very nervous. I think a lot of the underlying fragilities and the fault lines in the major economies are still out there. I think the volatility that we've experienced over the last couple of weeks has really left a lot of trading rooms in a lot of pain. I think that we've seen people cut back their risk exposures quite dramatically. At least they've been trying to do that. But the nervousness remains and the uncertainties remain. And, I think the outlook for the global economy still is very unclear, and there are a lot of potential downsides there.
Okay, well, let's talk about the probability of double dip, because some are saying, we got consumer spending coming in pretty optimistically, shall we say, on Friday, which rallied the markets in New York. Do you think the chances of double dip are where at this point?
I think they've definitely increased over the last few weeks. The numbers at the moment are not recessionary. The retail sales was a relief, as you suggested, but the impact of recent events is only going to come through with something of a time lag. The impact on confidence and so on, and the impact on investment spending and so on. So I think at the moment, probably something like a 1 in 3 possibility of a US double dip. We're already seeing the European economy slow quite considerably, the core economies in particular, and that's going to be something which is going to make the difficulties of the periphery even greater going forward. And then, of course, even in this particular time zone, we've seen the Chinese economy losing a little bit of momentum, nothing too dramatic yet, but it has been losing a little bit of momentum. So generally speaking, the economic activity picture seems to be slowing.
Okay, though I think the way you characterize in your client note is no sign of the fat lady just yet, but overall the world remains a dangerous and unstable place. Is that right?
Absolutely, yes. And I think that probably tells us that you're going to see investors continuing to emphasize the safer havens and the stores of value. Treasury yields are already extraordinarily low in a historical context, but they can probably stay that way over the foreseeable future. In fact, one could argue at the moment that the US Treasury market is effectively pricing in, should we say, the Japanification of the US economy over the next 10 years.
What does that mean? Does that mean stagnant growth for a decade or more?
I wouldn't say stagnant, but it means pretty soft growth, and certainly not the kind of economic environment that we've been used to in the US. This extended period where the recovery trajectory is pretty shallow, where really there isn't much of a pickup in core inflation, and where official interest rates, the federal funds rate, has to remain pretty close to zero.
Okay, before I go on to talk about treasuries, let me ask you if investors are missing the point. Because take a look at corporate earnings so far. Some are saying, corporates are doing really well. Isn't that the driver of the economy? So why are we being so, risk off right now?
I think the corporate sector does have an excellent cash flow position right now, but it's pretty unwilling to spend the money. And I think that is indicative of the lack of confidence and the lack of profitable investment opportunities that they see. Until there's greater certainty about the outlook, there's greater clarity about where the global economy is going, I don't think much of that cash is going to be put to work. So, good cash positions, but not a lot of opportunities to use it.
Okay, Russ, I'm going to give you a minute here, maybe less than that, to tell me where the safe havens are right now. Do you still get into treasuries when they're yielding pretty much nothing over 10 years?
As I say, I think as long as this environment prevails, the Treasury market's going to receive support, and there aren't many alternatives in terms of stores of value to the Treasury market. I think one would also expect the Australian government bond market, the New Zealand government bond market to continue to attract international attention because they are relatively high-yielding markets, and the underlying fundamentals in Australia and New Zealand are arguably considerably better than they are in much of the rest of the developed world.
Okay, well, what about Asian sovereign debt? Because I had an investor last week that says maybe that provides more safety than anywhere else in the world right now.
I think that's true, yes, but there is still, if you like, at the margin, a certain reluctance amongst some international investors to put their money in markets which aren't as well developed, which aren't as liquid, which aren't as deep as, say, the Treasury market or other major industrial government bond markets.